The current interest rates that are posted by the top money market funds, using them as just an example to look at the returns that we're getting from all the money market funds, have been going down compared to what we were getting the previous year. This year we are talking about 14%, 15%, 16%, and the declining trend is expected to continue for some time. This has raised a lot of questions that we can simply explain the reason why these changes do happen by using a river and its sources of water. In this case, our river being a channel through which the water flows will be our money market fund, which has been engineered by a professional, that is the fund manager. We as investors are seated at downstream at the tail end of the river, and we are collecting the water that's flowing from this river, depending on proportionately to the amount that we have assigned or delegated to the fund manager for purposes of investing on our behalf. And the sources of water to this river, these are the investment opportunities that are available to the fund manager, to which he has allocated the total assets that we have pulled together as investors in the money market fund, and the fund manager has allocated to these investments. So the returns, the interest that the fund manager is able to get from those various sources, or from the springs that are pouring the water to this river, the small rivers that are pouring their water into our main river, the fund manager can only give us as much as is able to get from these sources of water. The water that we are sharing being the total interest that we are getting from these sources, which the fund manager is sharing to us as investors proportionate to our investments, and this is after he has also taken care of the management fees relating to those investments. We'll be able to further look at these springs and sources of water being the opportunities that are available to the fund manager for investment, and the reasons why they do change, and possibly we'll also look at some things that you need to do as an investor in order to mitigate the negative effects of the declining interest rates. We shall look at all that after 3 seconds short break, so don't go away. In the meantime, as always, give a like to this video if it has a value, and engage in the comment section. And don't forget to share the video to another person. See you after 3 seconds short break. Welcome back, and if you are new to the channel, give us your subscription and hit the notification button so that next time when we upload another good video, YouTube will send you a notification. Let's look at first those sources of water to our river, and those are the available opportunities for investment to the fund manager when it comes to money market funds. The opportunities that are available are very limited to the fund manager. And the first most important opportunity is holding deposits with the commercial banks. These deposits can be categorized or divided into two. We will have the fixed deposits, which are term deposits, and we have the call and ordinary bank deposits. The fixed deposits are usually term deposits which go for a lengthened period of time, while the call deposits, these are balance or deposits that are held by the banks, which for the fund manager to be able to access them, then he has to place a call with the bank. Otherwise, they cannot be directly accessed immediately. But remember, we still have some funds that must be held by the fund manager's custodian account for purposes of facilitating the withdrawals by investors from the money market fund. The bank deposits in general are majorly affected by changes by the central bank rate, where the central bank is the regulator, and from time to time, central bank will issue a base lending rate to the banks, upon which the bank form their basis of lending rates. Banks will add several basis points or percentages, in most cases about 4% above the CBR rate that is given by the central bank. And the banks being the intermediaries between the savers or investors and the borrowers or capital users. The banks will borrow from the fund managers for on lending. And this is very important for us so that we look at the reason why now, if you are to analyze the asset allocations by different fund managers right now, you will realize that the fund managers have shifted a lot of their allocations from the government securities towards fixed deposits with banks, because the CBR rate, which right now stands at 10.5%, is giving us the very bottom or the minimums that the bank use to determine also what goes to the fund managers as their return. And by the virtue of the fact that the fund managers give the banks huge capital, they are able to bargain on the rate of returns that the fund managers expect to receive from the banks. Then number two, we look at the government securities, and we have two forms of government securities, or the treasury securities, and that is the treasury bonds and treasury bills. Majorly, money market funds will go for treasury bills because of their limitation in their maturity period, which as of now after the amendments now stands at 18 months on a weighted average. So sometimes you get a fund manager who has also invested in some short-term, medium-term bonds, but he has to stick to the weighted average of 18 months in the maturity of the assets that are held in that money market fund. But important is that the returns posted by the treasury bills, which also do determine the market interest rates, they are determined out of weekly auctions by the CBK, unlike the periodic determination of the CBR rate. So the returns that the fund managers are able to get from the fixed bank deposits are average higher compared to what we are likely to get from the treasury bills, because the treasury bills have a weekly frequency which generally determines what the new investment by the fund managers. And that is what informs or tells of the shift by majority of the fund managers what they were holding under treasury bills or government securities towards fixed deposits with the banks, this time that the market interest rate posted by the treasury bills have come way down to 10.5% compared to last year's highs of 17%, 16%, when fund managers had allocated sizable chunks of the assets under their management to government securities. The third source of returns or available opportunity for investment by the fund managers, these are corporate papers or corporate instruments. And they can also be divided to two, and that is we have corporate bonds and commercial papers. When the government is borrowing from the domestic market, it issues treasury bonds and treasury bills or treasury papers. So when companies are borrowing from the same market, they issue corporate papers. So the corporate papers and treasury papers are more or less the same in terms of their classification, where treasury bonds are long-term borrowing instruments by companies, while the commercial papers are the short-term version. In this case, mostly corporate instruments, their returns will more or less be dictated by the bank rates, but in most cases, because companies will be running away from the lending rates by the banks to access more affordable credit from borrowing directly from the primary markets. So in most cases, the returns posted by corporate papers will be determined by the market interest rates, which will always be lower than the bank rates. There shall be two forms of investments or corporate instruments as per the asset allocations of your fund manager. We have those corporate papers that have been issued by listed companies. These are companies that are listed in the stock exchange. In other cases, we call them quoted companies. Their instruments are called quoted papers or quoted securities or listed securities. And any instrument issued by non-listed companies or unquoted companies will be indicated as unlisted securities or unquoted securities. That is with reference to the asset allocation schedules of various fund managers. When you get your fund fact sheet and the asset allocation schedule, you are able to tell of the different classifications of different asset classifications that are held by your fund manager. And in most cases, fund managers will invest a small percentage of their assets under management towards corporate purpose, and in most cases for security purpose. And in order to mitigate or reduce the risk exposures to the fund, most fund managers go for listed securities or quoted securities. Only a very small percentage in one or two fund managers will hold a small percentage of the assets under management under unlisted securities. And with that, and with reference to the fact sheet of your money market fund, you'll be able to look at that and tell us what you have in the comment section. The other place where the fund manager is able to invest, those are collective investment schemes. And this is where a fund manager has invested part of the assets under management with another fund manager's collective investment scheme. And those ones are also giving some leverage to the returns that we are getting from money market funds if Saiton money market fund is to go by. Saiton for the longest time has maintained at least 30% of the entire assets under management in its money market fund under collective investment scheme. Sometimes could be viewed as the reason why Saiton has maintained as the highest paying money market fund as per the performance chart, because it has held a position number one as the highest returning money market fund for the longest time. Those are the four grouped sources of our water flowing in the river. We are getting interest from government securities. We are getting interest from investments with bank deposits. We are also getting interest with the instruments in commercial papers and other collective investments. Okay. Now, collectively, that is the main reason why we just use the term interest when it comes to returns from a money market fund. When we are looking at some special funds, we talk of an income because of the different types of returns that we are getting. For a money market fund, all returns from all the opportunities available or investment vehicles available to the fund manager, they all pay a return in the form of interest. Unlike when you're looking at balanced funds and on the other side, special funds, where we can also be getting dividends as form of returns. We are getting profits from trading in commodities as other forms of incomes, and therefore that is the reason we use a different term to refer to the returns that is being distributed, either in general as income or to some cases as returns. After exhausting the sources of the water, the interest that we are sharing, then now we need to look at some of the reasons for these changes, because we are not only talking about the declining trend, there is also a time we'll be talking of the increasing trend. But in most cases, increasing trend, when the fund managers are able to give us increasing returns or interest rates, we will not raise a lot of questions. Questions come when the interest rates are going down. And these are the reasons why interest rates do vary from time to time with what we have posted by different fund managers. And the first one is inflation. But inflation dictates very little, because inflation will be used by the government as the regulating the economy, that is the central bank. And in most cases, inflation touches on the market interest rate as per the treasury bills, and at times the CBR rate when the government wants to regulate or create changes in the economy. The second one is pure regulations by the central bank. The changes in the CBR rate heavily do affect the returns from money market funds. When the CBR rate goes down and banks are pushed by the central bank to reduce their lending rates, because banks in most cases take time to effect those changes. As they effect the changes, then the returns that are paid to the fund managers also have to be affected, and consequently, because that affects the water flowing in our river, we also get affected as investors because overall the returns will eventually come down. The other important thing that affects the fund returns is additional investments by existing investors. When you increase the purchases, the number of units that are purchased in that fund, because the total returns that have been received collectively, cumulatively from all those opportunities, have to be distributed to or divided to the number of units purchased in that fund. So as we increase the unit purchases or the amounts invested, then that figure will also be affected. The next factor that affects these rates is the strengthening or the weakening of our local currency. Majorly, these high returns are not meant to target the local investor. These returns are part of the return is made to cushion that foreign investor or attract foreign investors with high value currencies who have to be compensated for the notoriety of the local currency in its depreciation. And that's why when you do your math on whether to invest in a foreign currency, maybe a dollar, and compare to investing in our local, the rate of return in the top money market funds, you are likely to find that investing in the converting and investing in the local currency and on maturity or on exhaustion of your chosen period of investment, converting back to the other currency sometimes is giving you higher return compared to if you had invested in that other currency. And for that reason, then, considering the fact that our currency has remained at the same point around 130 for quite a long time now, only this time it has started changing a little bit. The increase or the changes in value of our currency also does affect generally overly the returns from these investment vehicles. Then we have the government policy and the market rates as posted by the treasury bills, because money market funds are heavily responsive to the changes in the rates as posted by the treasury bills. So the declining trend by the treasury bill is being mirrored or reflected in the money market funds because of that general responsiveness and the fact that a lot of investments are held in government securities. Then, what can you do as an investor in the midst of a changing investment environment? Because generally, money market fund returns or rates will always keep on changing. Either they are increasing or they are decreasing. And these are three things that you need to be doing as an investor when you are as an investor in times of declining or reducing interest rates. And one is putting or increasing the amounts that you are investing or increasing the amounts that you are periodically investing in that vehicle. And this will apply if you have a goal amount that dependent on the amount that you are investing and also the compounding effect of that particular money market fund. When interests go down, it means that the value when we determining the time it will take for you to achieve a specific goal amount based on a certain rate of return, it means a reduction means that goal will have changed and you can only compensate for the reduced amounts by increasing your amounts that you are periodically investing. The other thing is locking your returns in fixed instruments. Periodically, the government will be issuing infrastructure bonds or fixed coupon bonds with returns that match what you are getting from the money market fund or even higher. In such cases, it's advisable to cushion yourself against the interest rates risk posted by the changing returns in the money market funds by transferring a part of what you are holding in the money market fund to that fixed income instrument and locking your returns at that point. A good example is those investors who transferred their part of their investments to the IFBs in 2024, where we had returns of up to 17%, we had 16%, we had 15%, and that means that those portions of their investments that are now tied to those fixed income securities, they will remain giving returns at those higher rates even when these money market interest rates keep on going down. And that way, because we cannot underestimate the importance of a money market fund. That is where you are holding your emergency funds. That is your parking point or accumulation point. And therefore, you will always have part of your assets sitting with the money market fund. But for high returns, because money market funds don't give you the highest returns, we have high yielding investment opportunities, again, with some higher risks, because high returns come with some form of risk, but especially with the bond market, where the government has issued higher coupon bonds in the primary markets, evaluate and reconsider locking a part of your investment in the money market fund in such high returning instruments, which averages up the return that you're getting from your entire portfolio. And that does not mean that we are negating the fact of investing in higher paying options. That would be our option number 3. Consider investing a part of your investment in special funds and other high yielding investment opportunities. Those high yielding investment opportunities are the ones that will be averaging your returns to your target return as per your personal investment policy. Each investor has a personal investment policy to which he or she references for their acceptable rate of return. Then lastly, but important, keep investing in the money market fund. That is the entry point to investing, and very important for your sinking funds, very important for the emergency funds, and it's also available compounding platform or opportunity for your coupons that you are receiving from your fixed coupon bonds and infrastructure bonds, where the amounts that you are receiving are not enough to reinvest in the bond market. You make them available for compounding purposes in your money market fund accounts. Thank you for watching, and see you in our next video.